Hello, I'm here back again with another trade like a sniper video where I'll be utilizing a top-down analysis approach to frame a trade on a lower time frame using ICT's concepts for the most part. So you know the drill. I'm going to scrunch up the chart and then rewind starting on the 12 month, okay, here on the Australian dollar, New Zealand dollar pair using FXCM's broker data, okay, because it goes a little bit further than Wanda. So I'm gonna scrunch up the charts and go to a rather random point of time. So I don't want to go too far. Okay, it's a little bit far, but we're starting on the yearly, and I won't go to too low of a time frame. So as usual, I'm always looking for gaps to either be respected or disrespected by candle bodies. The bodies tell the story, and the wicks, they do damage. Okay, so let's fast forward this. Okay, we can make a gap here, that'll be great. Okay, the 12-month candle takes a while to form. Give me a second while this happens. Okay, great. Also great here, kind of perfect. We have a yearly gap. Okay, yearly gap. This should be 1 year, 12 months, whatever you want to call it. It's like parents and their babies. My babies are 36 months. Yeah, that's 3 years. Okay, so what do I notice? What does my eye catch? Liquidity, sell side. It's all relative equal lows. This area too. I like the body close below here and here. And I like this gap that formed. Okay, so I'm going to highlight the mean threshold of this wick. Let me put it a different color, blue maybe. All right, the yearly, great. It's nice. Okay, where's my target? Since normally the low here, but that is the target, and I'll definitely take profit there. But there's also a relative equal lows just below down here as well. Most importantly, yeah, definitely this low. Or near the body, which is near the low. The body's open, which is near the low anyway. So I'm gonna put the low. Let's go to a monthly time frame. Okay, so this is the yearly gap. I don't think it went in there yet. Okay, so monthly gap here, got used once, got used again. Either we come into this yearly gap, and I'm just going to annotate this monthly one here. Remember, this line here is the mean threshold of that yearly wick. So I want price to either come here, take an entry in here on the lower time frame, or price to close here and take an entry in here on the lower time frame, targeting these areas. Let's see what it wants to do. Okay, it looks like it wants to come into here. Let's see if it does or not. Okay. This was the yearly gap. This is the monthly. Okay, I'm just going to go straight to the weekly. Weekly came down, came back up, came down, and okay, I'm going to go straight down to the daily and see what all this looks like. Oof, a lot of wicks. Messy wicks. What do I see? Breaker here. Dun. Okay, this is the monthly gap. We didn't manage to catch one in here because there's so many wicks. Not great on this time frame. Okay. Oh, all right. I'm gonna go to the monthly because I want to see a monthly close, and then I want to see us to go back in there. Okay, we're in. We're in. We are in the monthly. Everybody. Ooh, nice, nice, very nice. I like this weekly gap. Okay, so what's changed? Still my first monthly target. Down here, still my second monthly target. So now I'm here on the weekly. I'm gonna go to the daily. Was this the daily? Was this the weekly that went in there? 1, 2, 1. I don't know if it comes in again. Okay. But now on this time frame, my target is this equal lows here, relative equal lows, and just this general swing low. Okay, so all right. I would like to. Oh, can I go to the 4-hour time frame? No, it's too far back. I can't go to a lower time frame. Else, I would look for a trade in here and potentially get a better RR move. Right. I may have found something on a lower time frame that allows me to catch a bigger RR trade. But since I don't know, I would just leave it at this high of this order block. Shouldn't break there. I don't know if we're coming up again. I'm not going to go to a lower time frame. Let's just say we ended here. RR very low here. But let's just see if we hit our target of this area, this area, this area. This is, sorry, these bottom ones are actually our yearly target, right? Because we came into that yearly gap. We want to take out the low. Now we're on the daily. Okay, back to this order block. Okay, so it just stopped us out by like very small amount. Okay, it'd be kind of funny if it goes all the way, but there's a nice gap in here too. Weekly inversion gap, all entries, these are all PD arrays that trades can be taken in. Okay, so let's see if we can find another gap. Okay, there's a gap here. At this point, I go to lower time frame. That is daily. Yeah, intraday. Go to the 1 hour, 15 minute. Find something that coincides with the day of the week, Thursday, Friday. Maybe there's some news. Okay. Not closing above. Not closing above. And it comes down, takes out that low. That would be a target. This may be a trade on. I don't know what's in here. Okay, but let's say, I caught that move, I'm targeting this low, whatever it is, 1 to 1, 2 to 1, whatever, wherever you get in. Okay, first target was below that low, and this was already a target. Spiked once, good enough for a bounce. Not deep enough for going to the upside, especially if we're not even bullish, right? Difference between catching understanding that there's a small pierce through liquidity will instigate a retracement, and whether small pierce in liquidity is a reversal. That all depends on your bias. So, okay. Wow, okay. Where are we here? We're in this daily gap. Wow, what a spike. Daily spike. Sorry, this yellow is daily gaps. Okay, now we're in this gap. Let's see what happens, right? Big spike, big candle to the upside. What's down here? Those relative equal lows. Yeah. You see, this is the trick. Okay, by all means, it could come higher before coming down again. But that's the thing. Watch out for these bullish candles. It's not time to take a long, I think. You see what I mean? What if you took you see this gap here? If you know, it's not ICT's concepts doesn't work. is that you don't know what you're doing. You see this fair value gap, you're like, okay, I'm gonna take a long of the breaker structure. I'm gonna target the relative equal highs above this area. Yeah. Oh no, dang ICT's concepts don't even work. I'm going back to my trend lines and my support and resistance. Yes, I do impersonations and impressions. There is liquidity above there, but this is not where we are, right? We started on the yearly uh, time frame, and that's our target, that small low, which we'll go back to in a second. Let's just see if we get our target anyway. Okay, it is coming back for that buy side liquidity. This is that monthly inversion. Monthly inversion gap. A lot of consolidations here. So we're near this area, building up liquidity. Okay, we get some. You can imagine that people are going long. They're getting scared. They're getting stopped out or holding the positions or whatever. There are people that are going to be trying to guess the move. Now it starts to go back up. People are trying to catch that. Goes down. They're shorting. Spikes up. More people are trying to go long. Comes down all the way here. People are like, oh, we were wrong. Comes up. People are getting confused in this general range. Okay, it's not moving. It's accumulating on a higher time frame. Something like that. You get the liquidity run 1, 2, 3 Indian spike, and we should take out the liquidity here because there's a higher time frame liquidity there. Okay, higher time frame is more important. You can think of someone bigger. Think of yourself going hunting. Um, the small animals, big animals, and then there's the giant blue whale, which is this yearly gap, yearly um, obvious area of equal lows that is a draw on liquidity sooner or later. They're going to build up as much as they can before hitting that, usually quite quickly. So let's just see. Still consolidating. So there are trades here to be taken, right? Into this gap, taking out this low, still in that range. Also intermediate lows into this gap. Let me use a brush. Where was there a gap? Like into this gap here, take out this low. Retrace into the bottom of this, take out the low. There's a gap here, take out the low, take out this low, retrace. There's a gap here. Are we going to take out this low, or we're going to move higher first? Let's see. Let me remove all this nonsense. Okay. All right. Oop. If you held a position this long and did not get out of it because you wanted to take out this area. Okay, so the buy side liquidity here, right, that we talked about. I believe we'll take out this low. So this is a scenario. We take out this liquidity and then we go straight for that, or we come down and then we go for that. I know it seems like, oh, well, that's the only two options, kind of. Not only two options. It could come up there and then continue higher, of course. Okay, so there we go. This was the trade here that we got into. So-called stopped out here, right? In this instance, but we saw that our analysis on these equal lows here and the equal lows there, we hit our targets. Okay, relative equal, we took it, and let's go back to that. Let's say, stay on the weekly, see what happens. Okay, you see, right? Everything's based on liquidity. Um, and that's how the market operates. It doesn't operate by trend lines and the bulls and bears are bouncing on, support and resistance areas. Took out the first one, meandered, more liquidity. You don't need a depth of market, order books, or footprint charts to kind of see that it's here. You can see it on the chart. With experience, you just know. It's like learning another language, and at the start you don't know what the heck you're reading on or looking at, and eventually you speak the language, or reading sheet music, or you're an artist and you paint, or whatever it is. It takes experience. Okay, so I'm going to cancel this replay mode, see where we were. Yeah, look at that. We took out that big liquidity, and boom, we went all the way up here. Oh my god, came all the way down. Goodness, on the weekly. Let's see, how many pips is that? It's like 2,000 pips, man. Boom, boom. I don't know what was that, but it came higher one more time. Took out liquidity above here. These relative equal highs, and then started going down. Took it again, and now it's in this area, right? Let's go to a monthly. So what can we anticipate on this? Relative equal lows. Depends if we're going higher or lower. What can I say? Imbalances in this area. Not yet. In a premium zone. This is premium discount. So there's things, there's an area to look forward to here. Here we came down. We did not make a new low. We might do, we might not. But this relative equal lows. One possibility is that we come down and then up, and then we come for this area, and then maybe even higher. There's a lot of pips in between, so we don't need to guess all that kind of thing. We're not trading such a long time frame. We're not taking one trade to end all trades to retire a few years later. Or we just come into there and then we go down, for example. And of course, it's always a possibility to go in and then go up. So we look at the small time frames, at the imbalances and gaps, and that's where we frame our trades, right? We might be catching no need to worry about all that. Our trade could be in here, catching this order block above these highs, stop loss, wherever you see it on a lower time frame. 2 RR is fine. 1, it's also fine, and maybe you catch a really big one on the lower time frame. This is a monthly time frame. Many hours in a month to catch near the bottom if we were going up. Okay, so that's it for this episode. Pretty cool. We got stopped out on that one by a micro thing, but it just goes to show that analysis is always right. It's up to you to manage your trades, and of course, if you were trading live, in real time, the real market, you have all the opportunities to wait and frame things based on news and lower time frames, which I obviously can't do here. So, yep, thank you, and see you next time.